Hello, everyone, and thank you for joining me today. My name is Michael LeBlanc, and I'm Senior Portfolio Manager with LLC Private Wealth at CG Wealth Management. And this is Mike on Money. Very excited to welcome everyone here today. I'm going to jump right into things to stay on time because it is a rather long one today. It's going to be about 15 to 30 minutes. But we're going to be discussing beyond stocks and bonds, access and exclusive small cap opportunities. And when I say beyond stocks, obviously we're talking about the traditional large cap stocks that the bulk of investors flock to, especially here in Canada and also in the US. But today we're really going to explore the Canadian small cap investments and how they can add a unique value to a portfolio beyond those traditional stocks and bonds. And by the end of today's session, hopefully you'll understand what small caps are, why they're often overlooked, the opportunities that they offer, the risks to be aware of. Of course, we're going to go through all those, and how a disciplined professional approach or process can unlock the potential while still managing a lot of those risks. We'll keep it practical, action-oriented, and focusing on clear takeaways that you can use. Now, we're not going to be discussing specific names here today. I wanted to keep this non-biased, but I am going to give you tips on how you can find your own names, get on our list to receive our picks and our top portfolio selections, and how you can find more names that might be appropriate for you. So we will cover those at the end, but we're not going to be discussing specific names in today's video. And now, before we dive in, just a quick note: this seminar or this webinar is for educational purposes only. It's not a recommendation or a promise of any returns. It's just solid information to help you make informed decisions. Any performance figures I'm going to show you, which I'll have again at the end, are historical, and as always, past performance is not an indication of future results. But with that said, let's jump into things. So let's start with, what are small cap investments? Well, what do we mean by that? Well, simply it refers to the small market capitalization, the total trade-in value of the company. So all the outstanding shares of the company, what is that worth? These companies are smaller, publicly traded for the most part. And in Canada, small cap typically is companies with a total market value of under 100 million. But some can be as small as 10 million. If you're talking about US, of course, small cap can be almost up to a billion. But here in Canada, small caps generally are below the $100 million mark. Many of those firms are traded on the TSX Venture Exchange or the Canadian Securities Exchange. These markets are for emerging companies rather than the main TSX index that most people follow in the news. The venture in the CSE are where the smaller companies tend to reside. So think of small caps as young, grown businesses as opposed to the well-known giants. They can be in any sector: tech startups, mine and exploration companies, biotech firms, niche consumer brands, you name it. Often these are more innovative companies, very nimble in new industries in many cases, and they can sometimes turn into household names of tomorrow as they succeed and grow. Just a key point here, small caps are not your typical blue chip stocks, as I mentioned. They're tiny compared to the banks and telecoms that most Canadians invest in. For example, your average TSX 60 company is in the $1 billion of size. And remember, these small caps are very small in comparison, which means they have more room to grow, but they're also more volatile. And we're going to dive into that volatility and what it looks like. So why venture beyond these traditional big cap bonds or stocks and bonds into the small cap arena? The big opportunity comes from the fact that small caps are often very under-researched. They're not followed by many of the research firms. They're overlooked by larger financial institutions. So when you look at the big institutional investors like mutual funds, pensions, these companies might fall too small for them to warrant even looking at, never mind invested into. So There's not a lot of volume in them and not a lot of eyes on it. So with fewer analysts and fewer big investors out there, these small companies, that also means less competition, often inefficiency in their pricing. So in other words, great businesses may be undervalued simply because they're flying under the radar. For a savvy investor or a specialist in the space, that's a chance to find those hidden gems, companies with strong prospects that others just haven't even noticed yet. So let me highlight a few reasons small caps can offer these attractive opportunities, and why we're excited about here at LLC Private Wealth. Higher growth potential. Obviously, it's way easier to grow a $50 million company to a double or triple in size than it is to grow a $50 billion company in a double or triple size. Small companies can grow revenues and earnings much faster rate, and if they hit a successful product or expansion, giving investors an early chance to get higher returns. And this is often called the average or the law of large numbers in actions. The smaller base, the larger potential for percentage growth. Um, they are target or takeover targets, smaller firms, if they have a promising technology or assets, are often acquisition targets for bigger companies. And when the large company comes in, they're going to offer a premium to the stock price, meaning the shareholders of the small cap can see a sudden jump in value. We don't necessarily recommend using this as the sole purpose for buying a small cap name. Generally that's just an added benefit if you've selected a good company. But we're always mindful when there's potential there. It's just not usually the driving factor. Diversification and innovation. Small caps, as I mentioned, come in a wide range of sectors. These even more so than the traditional big stocks of the TSX. So many innovative and high growth industries. Um, think of clean tech or biotech, emerging softwares, are all populated by small caps. And adding some of these niche players can actually complement your portfolio of large caps beyond the banks and utilities, and potentially, providing you a reduced overall risk in your portfolio through more diversification. So it's important to not just, it's important to consider them when you're building your portfolio. The other I mentioned earlier that inefficiencies in pricing, market inefficiencies can be taken advantage of much easier in the small cap space. They're under followed by the Wall Street and Bay Street groups, and with much fewer eyes on them, the price can sometimes deviate more than a good deal from their fair market value, both up and down. So sometimes they get overvalued if things are running hot, and then other times it can be quite undervalued if cash flows are slow there. And that's one thing we really do take into account is how much money is flowing into the venture market. If you followed our material in the past, you'll see we do put out on a regular basis the cash volume or the dollar volume that's moving in and out of the venture markets to keep a gauge on where we are in that valuation cycle. But for professional investors who do the homework, it's an opportunity out there to buy quality companies potentially on sale, and catch it before the rest of the market does. So all these factors suggest that small caps in appropriate exposures can add a higher potential to a portfolio's return compared to sticking with those large cap names. Indeed, historically, small cap companies as a group have often delivered strong performances over longer periods, albeit with those bumps along the way, right? There's the volatility. When we see volatility, often in the broad market, the macro view, it's even deeper in the small cap arena, and that's mainly just due to the sector as a whole or the space as a whole is often raising capital. Not all companies need to raise capital, but a lot of the small caps do. And when that dries up, so when the macro view is negative, and they can't raise capital, even if you have a good company who doesn't need to raise capital, they're going to be affected by downward pressures. So you have to be patient when you're looking at small caps. They can add that dynamic growth, but you're going to have to be patient through those periods. And it's critical, to keep that in mind because with higher potential returns, that always means higher risk. So let's talk about those risks in more details. So small caps can be volatile and risky. There's no doubt about it. It's important to go in with your eyes wide open. Price volatility is your number one. The share prices of a small company can swing wildly and quickly, much more than the bigger companies. And it's not uncommon to see the stocks jump or drop by double digits in a very short period of time. And it could be on one news item, or even just low trade in volume. You have to be emotionally prepared for the bigger ups and downs of your account balances when you're dealing with small caps. As I mentioned, they're low volume, um, and if no one's out there buying and you want to sell or get out, it could take you some time. That liquidity risk is they just don't trade as frequently, and if you're trying to dump a position, you might have to discount your price quite a bit in order to get that liquidity. So patience is key. Think of these things. Well, one, you should have a longer time horizon, and two, think of these things as semi-private equity portfolios. So when you want to go sell, make sure you have the time to do it patiently and properly to not to be able to get the fair market value or price that you want to get out at. Business risk. Obviously, by nature, smaller companies are often less established. They may have a single product line, much less capital. As I mentioned, they might need to raise capital, just to fill orders, just to build inventories, or have a shorter track record. Some could fail or certainly disappoint. A small mine in exploration might, never find the amount of deposits that they were hoping for, or a tiny tech startup could get outcompeted, before they really even take off. The probability of setbacks or even bankruptcy are higher, than a big, mature, stable company that could, weather, those kinds of blows along the way. Because of these risks, many traditional advisors and big banks, like as I mentioned before, they avoid the space altogether or give very little weight to them. They can be concerned, and rightfully so, that if done poorly, you could hurt your portfolio. And this is exactly why we're having this discussion here today, is to discuss how to pursue those opportunities responsibly and acknowledging the risk when you're going in. So we know that most of the risks, how do we mitigate that? Well, one way is through professional management and discipline, which leads me to the next section. Is here at LLC Private Wealth, our approach to small cap investing is a structured, risk-aware way. We can't get rid of all risk, but we can go in, take it into account and minimizing it as much as possible. And we do that through successfully. How we do that is successfully. It requires a disciplined process, which we put in not just in the selection process, but in the portfolio building. We have a team with specialized skills, and let me share, at a high level, how our small cap specialist group operates. It'll give you a bit of insight of, how you might want to look at these investments, certainly how we look at them and how we manage them. So first, we start with broad screening for idea sourcing. We cast a wide net. There are thousands of small companies out there. We use sophisticated screening tools and data mining to identify candidates that meet our criteria, from an earning solid financial health, strong growth prospects, underlying value of assets. And we leverage our network that gives us access to one of Canada's most sophisticated small cap ecosystems, meaning we can often hear about opportunities very early, and sometimes even exclusive private placements or pre-IPO opportunities that a regular investor might never see. So that's where we start with our ideas, and then the real work starts. We do a deep fundamental analysis for each promising company. We roll up our sleeves and we go through the due diligence process. This is the classic fundamental investing. We study financial statements. We evaluate the business model, the competitive landscape. The management team is very important. We meet directly with the company's management. Um, small cap companies do investor presentations and one-on-one meetings quite often. Our team has decades of combined experience in this niche. So, we know the red flags to watch out for and the questions to ask to kind of turn over those stones. We aren't relying on third-party research, which is scarce in most cases, if any at all. It's often us doing all our own homework there. On the risk management and position sizing, um, given the volatility of small caps, we manage the risk proactively by carefully sizing positions in a portfolio, diversifying across a number of different small cap investments. Currently, our portfolio's sitting around 17 different positions. In practice, this means we never kind of bet the farm on one single stock or overweight the portfolio in any particular name or sector even. The sectors can sometimes get heavier. Um, I was looking at the small cap index. There's a couple of ETFs out there that follow the small cap index in Canada, and they've done quite well over the last year. But they're over 40 to 45% in materials, gold and silver right now, just due to the explosion of that market in the last 12 months. So that's going to leave you holding the bag. If you have those exposures, you're going to be exposed to that risk if there's a pullback in that sector. So the index ETFs don't take into account um, sector exposures, and that can, especially in Canada, those can get out of hand really fast or become very large, increasing your risk very rapidly if you don't monitor them on a regular basis. Uh, we also look at when to deploy. When we're building positions, we can start small and gradually add to them as momentum picks up and positivity comes through on their news and developments. We can hold cash patiently, wait until we have a high conviction opportunity. We don't necessarily throw cash in the market. And I'll say right now, our cash positions have been building as we've been taking profits out of some great performing positions, and just being a little cautious in this market and timing right now around our deployments. So we take a very disciplined approach to pacing. Obviously, monitoring and active management is constant. We're always looking at all the names, we're constantly screening new names. We're looking at the broader market environment. We track metrics like overall trading volume, I mentioned in the small cap arena, to stay in touch with developments. We just have an update on that. We'll be putting that out shortly. Um, we look at the company's fundamentals to see if there's any deterioration or increased risks. We reevaluate the holdings constantly, especially when there's news or earnings, and we're always ready to adjust, maybe trim, or exit a position if it's warranted. This active oversight is key to protecting the client's performance numbers and protecting the portfolio. And probably most importantly, and this is where I think a lot of small cap investors struggle, is a clear sell discipline. We have predefined sell criteria. This is very important. You've heard the story before where someone's picked a great name. It's rallied, it's done incredibly well, only to ride it down as the price comes off. There is no infinite growth out there, so there's always going to be peaks and valleys to the story, and you need to be able to take profits or cut losses in these names. And for our small cap strategy, we typically trim or sell a position when the investment thesis has played out. For example, if the stock reaches their target valuation or is being acquired, or if we discover any negative changes to our outlook in the company story, could be management shakeup or missed milestones, just anything that's going to change our view of it going forward. By having these rules, we avoid that trap of falling in love with a stock and holding it for too long, and it keeps our decision making very objective. And that's really important, so much more important in the small cap space than in the large cap. The bottom line, if you're going to be in this space, you're going to want a rigorous, sorry, uh, process-driven approach is how specialists capture the upside of small caps while looking to mitigate any of that downside. It's the difference between a dartboard approach and an expert-guided approach. Here at our team, we've honed this process over many years. We're very devoted to the space. We truly enjoy scouring the small cap universe for our clients, and we do it with prudence and patience. So how does that play out? Again, the example of how we do it. Well, how is it done? Well, our small cap portfolio over the last 12 months is up 48.8% at the end of April 2026. And we were able to capture some of those exceptional opportunities through that process. Clients have been very happy. But however, I want to be clear, this kind of performance is, as I mentioned, not guaranteed. And going forward, we don't know what's going to happen, but we do know through our experience that using this process can be valuable in the portfolio over time if you stay disciplined with your approach. So, as I mentioned, let's talk about how you can get access to some of this information. Um, there's a few ways. So if you're looking at exploring the small cap arena for something new, I mean, reach out to us. Just give us a call. Go to the website, mikeonmoney.com. All our contact information's there. We're happy to review your portfolio, how it could fit in, give you no obligation consultation on how it could fit into your goals. If you have a current portfolio, we're happy to discuss that with you, bounce ideas off you, take a look at what your exposures are, maybe give you a few other ideas, or maybe identify a few risks if you're concerned. You can also join our small cap specialist group on LinkedIn. Again, if you reach out to us, I can send you that link. Also, the Mike on Money group on LinkedIn, you can go there or reach out to us, and I'll give you the link to that. Or just sign or subscribe to our monthly updates. We do put out our kind of monthly features, the ideas we're looking for, and if you want to hear about our ideas as we're going through, reach out to us, and we'll put you on that list as well. We're happy to discuss and share any of those ideas as they go through. So basically, what you want to do is make sure you understand your risk. You've identified the opportunity and how much exposure you want to have to the small cap space, and use a very disciplined approach to your selection process. Don't fall in love with names. Don't buy on theme. Make sure you're buying underlying value of a company that's underpriced. Remember never to overpay. I mean, that's true of any investment, but in small cap space, it's even more important. So thank you for spending the time with us here today. I appreciate your attention. If you have any questions, as I mentioned, just send them in. We'll happily answer all those. With that, wish you success in your investing journey. Take care. And this has been Mike on Money. Thank you.